Markets shrug off the crypto crash as inflation fears abate. China cracks down on commodity market speculation, triggering sell-offs across the complex. And the dollar slide seems to be running out of downside momentum. All this and more in this week's Macro Insight. Welcome to Macro Insight. Today is the 25th of May, and let's have a look at what's going on. So last week, obviously the main outside market was quite quiet outside of the crypto world, right? So if we look at the S&P, let me just share screen. If you look at the S&P, I've kind of marked that little dip that we had down towards 4060 as kind of the crypto spillover, because there was definitely that happened around Wednesday when the US came in, and that was definitely when the crypto sell-off was in full panic mode, and that often happens, right? So you get a bit of sentiment spillover from if you've got a certain asset class where it's really the shit is really hitting fan. Then it can make people nervous about general sort of liquidation of positions and de-risking in general. And that was kind of what we were seeing, right? Similar to when all that stuff was going on with GameStop, it had a spillover effect to markets, and because there's a lot of money in those markets, right? And there's a lot of people who trade equities and risk assets who also trade crypto. So when that bloodbath was happening in crypto, it was no major surprise that it had a bit of spillover to the S&P and to equity markets, but it should also be no surprise that was short-lived, and the equity market was able to shrug that off, right? So we had that little dip down to around 4060, and then as I had kind of been expecting, we then ground our way back up, into that zone where the street was a bit more long options, above 4150, between 4150 and 4200. And into expiry last Friday, which was a major options expiry, that's kind of where we headed, right? And we ended up settling at around 4165, 4170, basically, on that recovery. And the VIX, if we bring up the VIX, similar sort of story, right? The VIX obviously spiked in sympathy when we had that little spillover. The VIX kind of popped back to around 26, and then it got slammed back down as we approached expiry, as it often tends to do. And then over the weekend, we've kind of had continued grind higher in equities, as the main sort of thing equities have been concerned about has been bond yields and inflation. And if we bring up the 10-year, you can see that's very much stayed in check, right? So, that range 150 to 170 seems to continue to be respected, and we're back around that 160 level. So yields going nowhere, okay? And generally, you had a lot of Fed speakers recently. You had Brainard, I think on Monday, was at a conference talking about inflation being well anchored and allowing policy to stay loose, and that's kind of kept markets relatively buoyant. And if you look at the Nasdaq, obviously, which tends to be a little bit more rate sensitive, that's kind of recovering nicely, and it's kind of back to this 13,650 level, which is arguably a bit of a retracement level from that recent sell-off. So if it can't pop its head above 13.7, there may be risk of Nasdaq pulling back a little bit, but for now, the recovery seems to be intact. So that's kind of what's been happening there. Now, last week we had talked about inflation, and whether or not, the main argument here and the main thing that's going to drive a lot of asset prices is, whether or not inflation is transitory or not, as the Fed is suggesting. And last week we outlined a bunch of arguments against it being transitory and why the Fed might have got it wrong, right? We were looking at a few indicators and a few things to be aware of. So this week, I'm going to try and examine the other side of the argument and against inflation, right? And why it might actually be transitory, and why, you know, the risk, rather than the risk of Fed being forced to taper because of rampant inflation being the major risk for asset markets, maybe the major risk for asset markets might actually be some sort of negative growth shock in Q4. Okay. So let's sort of talk through that. So what have we seen? We've seen commodity prices have gone up dramatically. Okay. And that's been one of the things that has had people spooked with regards to inflation. Okay. But what's driving commodity prices? Arguably, there's quite a lot of speculation in commodity prices. Okay. So commodity prices might be being driven up more by speculation and obviously by short-term supply bottlenecks, but not necessarily true persistent demand. Now, we'll have certain commodities where it does seem like the demand story is very, very intact. Things like copper, given what's happening with the decarbonization and the whole electrification of the economy going forward. But then you look at some other commodities and you wonder whether it's a little bit more spec money just piling in when we look at some of those agricultural commodities like corn and wheat and things like that, right? So, you know, there is an argument there that, and you look at what China's doing. China's been trying to clamp down a bit on that speculation, right? And talking about, no tolerance for hoarding of materials and basic resources and things like that. And that triggered a bit of a sell-off in the iron ore market of around 10%. So you got China saying that they see the speculation and they want to try and stop it. And then also the Chinese economy, right, is going through a bit of a deleveraging. So whereas past commodity super cycles have been very much built on Chinese demand, there is an argument that suggests that China's economy, is kind of on a bit of a downturn, a bit of a downtick. You look at some of the industrial production and leading economic indicators that maybe we can't have a commodity super cycle without China, right? So that's kind of one of the arguments there. You've also had Korea and Taiwan exports at record highs, right? And apparently, you've got container ships waiting to be unloaded at major US ports, suggesting that even though we have supply chain shortages right now, that might well be short-lived, right? So when they do finally unload these ridiculous amounts of containers, then you're suddenly going to see that supply come back online, okay? And that's the argument for where it might be a bit transitory, okay? And because of COVID and because of the disruptions of COVID, it's taking longer to do things like that, right? So it just might be that once we get a full reopening and things are operating normally as they should, then some of those supply bottlenecks will go away and we can actually have the supply side respond to the demand that we've seen, okay? And the point that we were making about inflation, longer term inflation going up on the back of deglobalization, the deglobalization argument that now after COVID, people have seen the fragility in the system of being too reliant on supply chains from Asia. Well, actually, if you look at what these exports are showing us from Korea and Taiwan, that hasn't really changed, right? So globalization and world trade seems to be alive and well. So maybe that narrative is not really that true, okay? And then you've got the demand side where the fiscal stimulus that we've had to fuel some demand is likely going to run out in autumn, okay? So, if we've seen, just as the supply comes back online, right, from a fully reopened economy in autumn, we saw last year as stimulus checks were running out, fourth quarter growth was not great, right? And that's why Biden and Trump had to get some more stimulus through. So, the question is, are we going to see a similar setup where stimulus is fading in the fall, as they call it in the US, and it might be hard to get another couple of trillion through Congress. It might be harder given that the narrative is that the economy is booming and everything's great again, right? So you've got that. And then what we were saying about the labor shortages and the labor force and people not needing to work because they're on benefits and they're getting this free money from the government. Well, if that runs out, then suddenly you've got a large amount of the labor pool that comes back online, right? So you've got a lot of these things that we think are going to create inflation and are creating inflation may reverse themselves by Q4, right? And there are signs of that, okay? People talk about the money supply and the massive increase in money supply creating inflation, but you can't have that without velocity of that money supply, right? And velocity of money has been contracting for decades because we're choking on debt, right? If we're choking on debt in all the different parts of the economy, you know, that is one big secular deflationary force, that debt burden. And that debt burden really has only gone up since the pandemic, okay? It's gone more onto the public sector, the government debt, but it is still debt of the overall economy. And if you look at what people have done with their stimulus checks, there's evidence that they've actually been using stimulus checks to pay down debt, right? So if I look at this here, got this chart. This shows that credit card balances actually have dropped considerably, right? Suggesting that stimulus checks have actually been used to pay down debt rather than go out and spend, right? So it's something to be aware of. If people are paying down the debt, then you're not necessarily going to get the spending that you're expecting, right? What else? And then you've got wage increases, okay? So now there's this thing that wage increases are going to create inflation. And we talked about if there's a labor shortage and people are going to have to hike wages to attract people, and then when wages go up, they're sticky, basically, right? That's going to fuel inflation, right? But something that people don't really mention or talk about too much is productivity. Okay, and this is what I found quite interesting, right? So you can have wage increases, and if you have wage increases without productivity increases, okay, then that's going to probably lead to some sort of inflation, okay? But if you get wage increases, but you also get, you get wage increases, but you also get a load of productivity increases with it, then that doesn't necessarily have to create inflation, okay? So if you look here, what have I done with this? Okay, we've got business spending on automation last year expanded by 7%, okay? And at the same time, last year was the best year for productivity growth in a decade, right? So that is something to be aware of, right? If we had this massive move towards digital and work from home, and we had all this productivity benefit and efficiency benefit, then maybe we can get away with wages rising a bit without creating massive inflation, basically, right? If the economy is actually producing more, yeah? So that's something to be aware of. Okay. So those are just some of the counter arguments that I've been seeing and have kind of caught my attention with regards to inflation and this narrative and this story about whether it's going to be transitory or not. And that is going to have a big read through into what asset markets kind of do. Yeah. Okay. So that's kind of what we've been seeing and what the big kind of question mark and narrative is, right? And what we need to kind of get to the bottom of. I mean, no one really knows the answer, and we're just going to have to keep looking at the data and keep reevaluating what we think on that. Okay. In terms of other markets, Europe is looking pretty good, looking pretty buoyant or bullish. DAX kind of eked out back to its highs. Eurostoxx also at its highs. I'd been pitching this EWG ETF because of the extra exposure that you get to the euro if you get a European rally plus a euro rally, and that has broken out from its recent high and is kind of sitting up at its recent highs right now. So that's worked okay. So those July calls that I've got are kind of doing okay. You've also got China finally starting to show some signs of life. So we've got a bit of a bounce in China overnight. And, you know, I've been saying, you know, the Chinese equities have been looking terrible recently. And they've been consolidating for ages, but they've started to lose momentum on the downside. We're starting to see some of that bullish divergence, and that's why I bought some China. I did dip my toes into China, and we had a good move, like I said, a really decent move overnight of about 4% in China. Yeah. Now, in terms of China tech, that's still been a bit of an underperformer. So if we look at kind of how China tech is looking relative to, say, the NASDAQ, you know, you've got a bit of a gap there still, that a bit of a catch-up trade there that could happen, right? So if you're looking for pockets of value again around the place, maybe if China's now going to start to get some momentum going again, the China tech trades, or whether it's this HS Tech Index or whether it's the KWEB ETF that I've often been flagging, you know, there might be opportunities in there, right? So let me bring up the KWEB. KWEB here, you know, still got room to rally, right? If this thing wants to start recovering, there's loads of room. I mean, the highs that it reached back in February are miles away, right? But, you know, 30+% away. So something to kind of look at there. So that's kind of where we are in equities. And then coming up this week, really, the only interesting things, you've got consumer confidence in the US today. You've got durable goods on Thursday, and you've got PCE inflation, which is the Fed's preferred sort of measure of inflation, on Friday. Okay, so those are the main data points on the macro that you want to be looking at. If we then move over to FX, so the dollar continues to be the main sort of story here. And what is it going to do? Now, I've said we had a big long-term support zone between the 88 and 89, and you know, looks like we're heading for a test of that zone. But if you look at the kind of price action in the dollar, it started coiling, right? You've got this really narrowing kind of coiling price action here. And often what happens there is you then get an exit of that and then a reversal, right? So what I can kind of see a setup where we might break out of this, sort of zip down into that 88, 89 region in the dollar, and then stage some kind of more meaningful bounce. I'm not saying the downtrend in the dollar's over, but I think the dollar is starting to feel getting close to a bounce, right? So I think a bounce is on the cards, a bounce within a bigger, longer term downtrend for sure, but something to be watching out for, I would say, on the dollar. Yeah. Now, something that I kind of dipped my toes into as a way to play a bounce in the dollar, and a little bit prematurely, but I think it's still an okay trade, is dollar CAD. So we bring up dollar CAD and we look back, it's at quite a major level in terms of longer term levels. And dollar CAD is, you know, looking very, very oversold. You look at the weekly RSI down at 20 odd. You look at where we are on the Bollingers, where we are on the long-term chart, and also oil had started to have a bit of a pullback. So for me, dollar CAD is probably not a bad way to play a dollar bounce if you think a dollar bounce is starting to look more likely, right? So that's kind of how I've done it. I'm not going to get married to that position. Probably at 119 or something, stop on that position is what I'm looking at. So, but I think that might be an okay way to play a bounce. What else? So that's kind of FX. Commodities, obviously oil, talking about oil with the dollar CAD trade. Oil had a bit of a pullback last week, right? And that was on the back of what I've called the Iran blip, yeah? And so we had news that, you know, Iran back on, you know, talking about the nuclear deal, talking about potentially getting the sanctions from the US lifted if they can come to some sort of agreement. And that would mean a load of Iranian oil supply hitting the market, basically, right? Which in theory has not been happening, okay? So that spooked the oil market down, kind of broke this short-term uptrend below sort of 63.5. I had some trailing stops actually on an oil position that I bought in the high 50s that got triggered. So I'm out of oil right now, got triggered at around 62.5. but we have recovered since then. And the truth is about the Iranian supply is that, you know, markets kind of realize that Iran has still been supplying oil to the market, but just indirectly in kind of under the radar ways, right? So there's probably some direct supply going on between Iran and China that has been soaking up a lot of that Iranian supply anyway. So at the margin, how much more supply do we really get if that happens? And that's kind of what the market's kind of grappling with and getting to terms with right now. Okay. So that's oil. I still think, you know, this 68 level, if it breaks, then we're headed to 75. So even though I'm flat right now on oil after that trailing stop got it here, if we break through 68, I may well play the break towards 75. I'll be kind of looking at that. Yeah. Then if we go into gold, we'd been talking about gold, you know, breaking out above that 1860 downtrend resistance, but it hasn't really accelerated. It's been pausing, right? So no major acceleration up towards that next level of 1960 as of yet. But you know, what are the main drivers for oil? For gold, real yields and the dollar, and they've both been pretty stable. Okay. You've had Morgan Stanley have got this model that they look at where they imply the fair value for gold based on the 10-year tips real yield, basically. And if I share this screen, you can see that model kind of tells you where we are, if we're undervalued or overvalued on gold versus that implied price from the 10-year tips. And kind of back in April, we were about $100 undervalued according to their model. And now we're pretty much sitting bang on their fair value, right? So that suggests that gold may have been trading a bit too discounted and sentiment was quite bearish in it, but now it has caught up recently through that rally and is caught up with where it should be versus everything else in terms of where the real yields are, basically, right? So until we get a significant move in real yields or a significant move in the dollar, wouldn't really expect gold to do anything major in the short term. Yeah. So that's gold, and then silver, no real kind of difference there, right? So silver and gold kind of running to the same beat right now. And then the other commodities, as I mentioned, you know, China's kind of trying to crack down a bit on speculation, and you know, as such, they've you know been hiking margins and things like that on futures exchanges, and they've been you know saying, you know, people are going to get penalized if they're hoarding raw materials and stuff. That's what shot down the iron ore price and the steel prices recently. And you've had some consolidation in some of the other ags, right? So if you bring up some of the other commodities, such as ags, if you bring up things like wheat, you know, after hitting 7.5, we're back down to 6.5, pretty decent correction there. Similar story on corn, decent pullback on corn. Things like palladium, similar, and even copper, which we know and love, has been consolidating, right? So my first pullback level on copper was 450. I have actually bought a scrap there. I've got more levels down at 435 and 410-ish. And so I would look to pick up copper in any pullback there. I've probably got more conviction on copper than I have on things like ags. I think there's a planting season going on. So it's not clear where the supply demand dynamics are going to come in on some of those grains. So I would be more comfortable being long copper than being long grains, right? Even though grains have had a reasonable pullback, probably more of a dramatic pullback than what copper has recently. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.